We're here right outside of Yellowstone, having some coffee this morning with our neighborhood buffalo. We got some breakfast, just finished up making eggs. We're gonna head back up into the mountains. They got a little bit of snow. I don't know how much you can see that up there, but okay. We're going to move on and we're going to talk about solving problems relating to bonds and expected future cash flows. So bonds have both features. They have a single sum and they have an annuity feature, two features for bonds. Because, so we take a bond. If you wanted to calculate the present value of a bond. So for a bond, let's say I'm an investor. I am going to well, let's take the company example. We're doing accounting. We're usually accounting for the company, not the investor. So the present value of a bond, that's the amount, that's the liability the company needs to report on its balance sheet, is the present value of the bond. So if we have, say, a $2 million bond, 10-year bond, that means in 10 years, the fact that it's stated as a $2 million bond, that means there is a bulk cash flow of $2 million flowing out from the company at the end of 10 years. That is one cash flow. We know $2 million is going out in 10 years. So we would have to calculate what is the present value of that $2 million. That's a single sum. $2 million, 10 years at whatever our interest rate is. Now, in addition to that, bonds have periodic payments. Typically, these are quarterly. Most of our examples will work quarterly or annually for simplicity. But let's say for these 10 periods, the bond is paying $140,000 every period for 10 periods. Okay, well, there's an annuity, and you're going to pay this at the end of the first period, at the end of the period at which you borrowed the money. So it is an ordinary annuity. So what we need to calculate is the present value of an ordinary annuity of $140,000 for 10 years. So the bond value is composed of two different calculations. The first is, what is the present value of the single sum, the $2 million that we have to pay at the end of the period? And what is the present value of the annuity, the ordinary annuity of $140,000 every period for the next 10 periods? Those are the two series of cash flows that we're figuring out what's the value of the bond today. Now, if you're trying to sell this bond, that is the value you're going to probably receive when you sell the bond. Now, bonds have stated interest rates and they have stated amounts. So there's a face value of the bond. In this case, that face value would be $2 million. And the stated rate would be paying $140,000 every period. So that's how they're kind of laid out. So let's take an example that a company issues $100,000 of 5% bonds that are due in 5 years. Interest is payable annually at the end of the year. So it is an ordinary annuity. The current market rate of interest for bonds of similar risk is 6%. What will the buyers pay for this bond issuance? So what will the buyers pay, i.e. what will the company receive? Now, a couple things to keep in mind. The bond itself has a stated principal and a stated rate. That is the rate at which they're paying based on the stated principal. That is not the same as the value of the bond. In this case, the market is demanding 6%, which means the company has to pay 6% on the money they're borrowing, not 5%. Yeah, the bond says that it pays 5% of $100,000, but the market wants more than 5%. So if you were to say, hey, I have a bond, it pays 5%. Will you give me $100,000 for this $100,000 bond paying 5%? The market would say, no, we won't give you $100,000. We're going to give you something less because we're not willing to take 5%. You're too risky. We want 6%. That's how this works. And that's why we have to do these calculations. Typically, it is very, very rare, almost non-existent, for the actual rate that the bond's issued at to match perfectly the stated rate of the bond. And that's just because market rates, what markets expect, especially in like a public bond market, that rate's changing throughout the day. The rates change. So it's impossible for the bond to actually state the exact rate. And it would be different. If you sold some of these bonds in the morning and sold some in the afternoon, they'd have different rates because during the course of the day, the interest rates could have changed, which they don't infrequently do. So the question is, what is the present value? How much can the company get from issuing these bonds? Again, these are $5,000 bonds, or sorry, it's a $100,000 face value bond paying 5% interest. So it's paying $5,000 a year. That's just 5% of $100,000. It's paying $5,000 a year. And then at the end of the period, we're going to pay $100,000, which is our bulk sum. We're going to pay back the $100,000. And we're also going to make our last interest payment of 5%. So our series of cash flows is $5,000 every year. And then the last year, we have the $5,000 plus the $100,000, so $105,000. So we're going to start by calculating the value of the annuity of $5,000 for 5 years at 6%. We're using 6% because that's what the investors are demanding. If you want to figure out what is it worth, you need to use the market rate or the investor rate, not the stated rate of the bond. The stated rate, the only purpose of the stated rate is to determine the cash flows. Once you know the cash flows, all your discounting, all your time value, present value calculations are using the market rate, whatever you can actually borrow money for. What's the rate or what's the cost of borrowing that money? It doesn't matter what the bond says. That's just determining its cash flows. So we used the stated rate and the stated amount, the face value of the bond, to determine the cash flows. Once we know the cash flows, we're going to use those to calculate the value. Let me say that again. We use the stated rate of the bond and the stated amount of the bond to calculate the cash flows. Once we know the cash flows, we're using the market rate to actually calculate the present value of the bond. So we're starting with the series of cash flows. It's $5,000 for 5 years at 6%. So our factor in this case is 4.21. We'll multiply that times $5,000, which gives us a present value of $21,061. That is the present value of the interest payments of the $5,000. Those are worth $21,000. And that's just taking the $5,000 payment, discounting it back at 6% for 5 years, $21,000. So we know one piece. Now the next piece is at the end of that period, the company's also going to pay $100,000. That's the face value of the bond. We need to discount that back to today because we want to know what's the value today. So that's just a single sum, 5 years at 6%. The factor is 0.74, so we multiply $100,000 times 0.74, gives us a present value of $74,726. That's the present value of the single sum, or the present value of the face amount of the bond that we're going to have to pay it when the bond matures. So it is worth today $74,000. We add the two together. So we take the present value of the interest payments, which are $21,061. We take the present value of the principal payment, which is $74,726. We add those together. The bond's market value is actually $95,787. Note, that's less than the face amount of $100,000. It is because the market is demanding a 6% return and the bond's only paying out a 5% return. The bond is paying out less than what the market demands every year. Well, that means the market's just going to give you less money up front than what the face value is. Now, you could have the situation where the exact opposite occurs, where in this case, let's say the bond was paying out 8% and the market only demanded 6%. Well, then the market would actually be willing to pay you more than the face value of the bond because you're paying out 8% when the market's only demanding 6%. Well, in that case, the bond value is actually higher than the face value of $100,000. But in this case, the bond is paying less than the market demands, which means the value of the bond will be less than the stated or the face amount of the bond. It's actually $95,000. So the journal entry, so getting back to journal entries, the journal entry to record the issuance of this bond, the company is receiving cash of $95,787, right? The market bought it for what it's worth today, which was $95,787. Now, the difference between that and the face amount, so the bond payable is $100,000, but we're going to discount that back to today. So we are going to record bonds payable for a credit of $100,000, but then we're going to actually apply a discount to that, which is a debit for $4,212. That our equation now balances. So, and that discount on bonds payable, that is a contra bond account. So it reduces the value of the bond. And now what we're going to do is we'll actually amortize that over the life of the bond as we use it up. So that's our entry to record the bond. Now, we are going to amortize that over the life of the bond. So the carrying value of the bond is the $100,000 minus the $4,212 discount. So our carrying value of the bond is $95,787 at the time of issuance. That's how much money we borrowed. We borrowed that amount of money at 6%, right? Now the bond has a face amount of $100,000 at 5%, but we only borrowed $95,000 at 6%. That's how it works out. So in our first year, we're paying $5,000 of interest, but the interest expense is 6% times $95,787, right? Because we're paying 6% on the amount we borrowed. We borrowed $95,787 at 6% interest. So the interest expense is $5,747. That's more than what we're paying out of $5,000. It's more by $747. So that difference we're now going to, well, that's amount that accrued that we didn't pay out. So it increases the value of the bond. Now at the end of our first year, the value of the bond the net carrying amount, or the carrying value of the bond, has gone up to $96,535. We just keep doing that. So now for year 2, we are borrowing $96,535 at 6% interest rate. So our interest expense is $5,792. Well, we paid out $5, which means we incurred expenses of $792 more than what we paid out. Well, we're just going to take that extra amount, put it into the carrying value of the bond, which increases the carrying value of the bond from $96,005 to $97,003. It went up again. We just keep doing that every year for 5 years because that's the term of the bond. At the end, we end up with our discount, in this case, goes to zero. We've used up the entire discount. The carrying value of the bond is the $100,000. That is the face value. And if you recall, that $100,000 is what we have to pay out at the end of that 5th year. So we have that $100,000, we pay it out at the end of that 5th year, and the liability goes away. So that's how it works. Now, there are some, there's using this same concept. So real quick, that's something you should know how to do. That's a very practical accounting example for using both a single sum and annuity that's done all the time. So make sure you're familiar with that. The accounting for that, very basic discount amortization calculation. You, at this point in your accounting knowledge, you should be comfortable doing that. So FASB has also issued, there's a concept statement number 7, which introduces this expected cash flow approach. Expected cash flow is just taking this idea that, like, okay, well, so far all of our calculations have assumed some amount, well, or some return. So we bought this piece of machinery and we assumed that it was going to produce $100,000 or whatever, $5,000 for the next 10 years. Well, okay, that's great, but there's some chance it'll make less. There's some chance it'll make more. So if we wanted to actually work through the whole problem, we could actually say, okay, well, there's a 50% chance that it makes $5,000 a year. And then there's a 20% chance that it makes 6 and a 20% chance that it makes 4. And then we have to fill in all of our percentages so that we get to 100%. And then we just figure out, okay, well, what is our actually expected cash flow? Maybe there's a chance that our cash flow only lasts for a year. That would be problematic. So anyway, that's expected cash flows. We're not going to go into a ton of detail on that, but I just wanted to introduce that concept to you at this point and know that it turns into a weighted average calculation, where you calculate the present value of different worlds that exist in the future, different possible outcomes, and then weight them according to their probability, which gives you an expected cash flows. So know that concept's out there. It's getting rolled into some of the note disclosures a little bit, but at this point, I'm probably not going to, other than knowing how it works, I'm not going to expect you to really be able to necessarily calculate it out. That's something you should be familiar with, but calculating it out is not something we're going to deal with at this point. So that wraps up our discussion of the time value of money. Hopefully you enjoyed it. We had some great scenery and a beautiful time out here. Get out, enjoy the day, and God bless.